Imagine waking up one morning and realizing your entire savings just vanished. That's exactly what happened to millions of Americans in 1929. In this video, we're going to explain the Great Depression using bananas, monkeys, and simple storytelling. Welcome to Bubble School. Here, you can understand one of the biggest financial disasters in history without a PhD in economics. After World War I, America's economy was booming. Factories were producing more goods than ever before. New inventions like cars, radios, and home appliances were everywhere. People felt rich, even if they weren't. Banks made it easy to borrow money. So instead of saving up, people started buying things using loans. Soon, everyone wanted a piece of the stock market. Teachers, barbers, factory workers, all buying stocks. But there was one big problem. Many of them weren't using their own money. They were borrowing money from banks to invest, a strategy called buying on margin. As long as banana prices went up, everyone looked like a genius. Because more monkeys kept buying bananas, prices kept rising. This created a dangerous loop. But here's the truth. Bananas weren't becoming more useful, they were just becoming more expensive. That's called a financial bubble, when prices rise far beyond real value. In October 1929, something changed. A few investors started to worrying that banana prices were too high. So they sold. Other monkeys saw this and panicked. They sold too soon. Millions of bananas were being dumped on the market all at once. In just a few days, the market dropped dramatically. Billions of dollars disappeared and panic spread across the country. These days became known as Black Thursday, Black Monday, and Black Tuesday. Banks had loaned money to people who could no longer repay their debts, so banks began to fail. When banks failed, people lost their savings, businesses couldn't get loans anymore. So they shut down, factories closed, workers were fired. By 1933, nearly 1 in 4 Americans had no job. The crash alone didn't cause the Great Depression. It was the chain reaction. Too much debt, weak banks, and falling spending. As people lost jobs, they stopped buying goods. The economy entered a downward spiral that lasted for years. So what can we learn? First, when everyone believes prices can only go up, that's usually a warning sign. Borrowing money to invest can multiply gains, but it can also multiply losses. Financial bubbles can hurt entire countries. And even today, nearly 100 years later, markets still form bubbles, and sometimes they still pop. Do you think something like the Great Depression could happen again? Let me know your thoughts in the comments. Don't forget to subscribe to Bubble School. We turn confusing economics into simple stories anyone can understand. Thanks for watching.